I would say that cash on cash is by far the best metric that you can ever look at real estate from. You know, a lot of people, and don't get me wrong, myself included, I just bought an apartment building a couple weeks ago and it's got $200,000 in equity in it day one. So equity is important, but I think that, you know, during 2006 and seven, especially with jumbo loans and, you know, um, appraisers, you know, overstating values. Like everybody was so fixated on equity at that point in time, and it just was unsustainable, right? And when the market contracted, you know, I built a brand new house in 2007 and lost 40% of my value within like an 8 9 month time frame. And when you see that, it just makes you really realize that it doesn't really matter how much equity you have. It matters what's your cash on cash return. How much money can I put in this and truly get a ROI on that money? Because you know, in some markets, and I know some investors that invest in like New York, where you know you really don't get a cash on cash return. They do play the equity game, but that market is such that it allows that, right? That's just kind of the makeup of that market in New York. But for 90+% of the country, you really better be focused on what's your cash on cash return.
That's great. Could you elaborate on the cash and cash returns for those who may not understand what the cash and cash on return is?
Sure, sure. So it's just a fundamental of, you know, if I put um $100,000 into something and I get $1,000 out of it, then I got a 10% return, right? A cash on cash, that's my cash on cash return on that money that I invested.
That makes sense. That makes sense. That is definitely great. So you went through that process. You've started building it up. So how did you go about looking at properties, saying, okay, this is the house I'm gonna flip, or this is the house I'm gonna get cash and rental income on. So how did you go about deferring which one you would do, which is property?
So it for us, and something that we really hone on in our program is getting clear on goals, right? So when you come in, we want to understand what's the objective. So for some people is I love my job. I just want to make, you know, more supplemental income to support my lifestyle. I want to go on trips. I want to do all these things. And so for those individuals, then it's a better focus at looking at wholesaling and fix and flip, because that's great active income that you can do in parallel or in tandem with your job, right? Whereas there's other individuals, excuse me, who come to me and say, Brian, I want to get out of my job. I want to retire from corporate America. I got to get out of here. Then we look at, while active income is okay, we really look at a strategy to incorporate passive income as quickly as possible so that you can start looking at residual mailbox money, right? So what happens is, let's just say you make, you know, 40 grand a year, it's roughly, you know, a little over 3 grand a month. Um, and you needed to replace that income in order to still give you the same lifestyle that you needed, then we would look at, you know, what type of investments do you need to make on the cash flow side that you can make these one-time investments that's going to pay you residually thereafter. Does that make sense?
That makes sense.
So that's kind of high level, you know, to figure out what's the plan, what's the goal. And then from there, more specifically, as you look at deals themselves, um, you know, if I look at a deal and it has a tremendous amount of equity in it, then, you know, and just so everybody's clear, that the equity is the difference between the money you have invested in it and the how much it's worth, right? So when we're looking at a fix and flip, let's just say, you know, it's a $50,000 purchase, it's a $50,000 rehab, and it's $150,000 value. So I know I got $50,000 in equity to play with in that deal, right? And for those reasons, depending on how much equity is in the deal, I may make the decision that is most advantageous to flip that deal. Or there may be not enough equity in the deal for me to get the return that I anticipate on the flip. And so for those reasons, it may be a different investor out there with a different profit margin expectation that I could wholesale that deal to. So instead of me, you know, flipping it at the 150, maybe I get it locked up at 50 and I wholesale it to somebody else for 60. and I make $10,000, they'll be all in at 110. Let them go flip it for 150, right? And then there may be a scenario where I say, you know what, the purchase and rehab is going to be, you know, 100,000. The house is worth 120. Where there's only $20,000 in equity. That's not enough room to flip the house. But with $20,000 in equity, I'm gonna look at this $100,000 investment. If I can make $1,000 a month on this 100,000, and I'm making a 12% return, then does that make sense for me to put the 100,000 here and make that kind of cash on cash return? Does that make sense?
Yeah, that makes sense.
So that's just kind of the process of evaluation. But again, I think that more importantly is getting clear on what the goal is. Like, what do you really want to accomplish out of real estate investing? And then it's easier to reverse engineer, the process by which you get there.
You're 100%. You're 100% right. And I know like a lot of investors or real estate investors, they have like a specific rule, like the 1%, 2%. Is there any specific rule that you follow in Pacific or?
Well, so we encourage our students, at least on their flips, to look at 25+% cash on cash returns, because typically once you add in financing, because we teach you how to do it without having any money or credit, right? But by evaluating the deal from a pure cash on cash return perspective, if the deal works at 25+% cash on cash return, more often than not, it also work once you add in financing and fees associated with the cost of money, to where the deal is still profitable for you as well. So that's one of our sticklers. And then, short of that, it's just unique to the investor. For me to do a flip at this point in my career, I mean, my number is a little bit different in terms of what my expectations are than somebody that's coming in and getting into the business. Because for me, it's just a function of my time that's invested and my energy that's invested in something. And that changes, right? Over 15 years, that's changed quite a bit for me. But I do identify with the 1% rule. I get it in theory, but to be honest, even on my rentals, like, I'm looking for something way better than 1% return. You know what I'm saying? But that is a good baseline for people if they didn't have nothing to go off of.
That's great. That's great. And I want to go into something you said earlier in terms of like markets. Like you said, New York market is kind of hard to kind of do flips, compared to other markets. So how do you go about choosing a market or finding a market? Okay, this is a market, especially now, which everything is on an all-time high and people
Yeah,
are selling houses. How can someone, say, okay, I'm gonna go to this place and start investing?
that's a really good question. So we teach you inside the course or the mentorship program how to find markets, and then how to identify markets within those markets. So and there's a tool, I'll give it out for free. It's bestplaces.net. And inside of that, once you know how to use it, there's a lot of data that's collated there to tell you specifically what markets you should be in, what ARVs inside those markets you should be approaching. Um, it's a lot of data there, but you got to know what you're looking for, right? The site is free, which is why I gave it out, but you still need to know what you're looking for, because it could be information overload, because it's a lot of data there. And so you need to know specifically what metrics should you be looking at in order to make those determinations. But it's not a guessing game. And I'm glad you asked that question. You shouldn't, I mean, to some degree, just based on relationship with people in certain placements throughout the country, you may say, you know what, my homeboy live in Atlanta. I always wanted to like look at stuff in Atlanta. Maybe he can help me. Like, I think that's a good enough starting point. But then we have a responsibility to drill in and make sure we're making decisions based on data, and not just arbitrarily the fact that, we like a market, if that makes sense.
That makes sense. That definitely makes sense. So that leads us to my next question. What are your thoughts on the current market? Like, where do you see the market going? A lot of people think it's in a bubble. A lot of people think, the time for it to pull down. Lumber is at all-time high. And things are getting very expensive.
Yeah. I I think that what we see right now is a byproduct of pure economics. Economics 101 is supply and demand. Right now, there is a shortage of supply, and whenever demand is higher than supply, then I mean prices will increase, right? That's purely what we see right now. It's not that the market is hot, but it's hot relative to the fact that there's a shortage. Whenever there's a shortage, then there's an increase, and whenever there's a surplus, prices will come down. And so, once these rent moratoriums are lifted, which that just got pushed back again, and these forbearances, I think we're going to see a healthy diet of inventory hit the market to the tune of a couple million properties over the next 6 months. And when that happens, while I don't think that it's going to grossly affect every market, I think some markets are going to be grossly affected to a point where prices are going to come down in a lot of cases. And I think as a whole, it'll kind of balance out the market, that we'll see prices start to normalize in a lot of places. And then to answer the other part of that, hyperinflation is happening right now. The media keeps telling us that it's not, which if you're paying attention, anything the media tells you, you should always go the opposite
Yeah.
way. Hyperinflation is happening as we speak, and it has to, because we're just printing money, right? We got a fiat currency, it's not attached to anything. And so, hyperinflation is happening. What I can tell everybody is you got a couple different choices. You could leave your money in the bank and lose, 10, 20, 30, 40, 50% of its value, or you can park that money into assets. I like real estate. It's a tangible asset I have more control over, and you can hedge against inflation. So if inflation goes up, typically year over year is 2 to 3%. It goes up this year 8 to 10. Well, what do you invest your money in order to get at minimum 8 to 10% return? Well, real estate is a great place to do that, and that way you can hedge against the cost of goods and all the rest of it. But if you leave your money in a bank, then you're going to lose the value of your money, is going to decrease significantly.
No, you're 100% right.